Hello, welcome to this episode of the Financial Incline. I'm your host, John Bobard. Today, I'm thrilled to be joined by Mike Bergeron. Mike is the co-founder and managing partner of Strength Capital, which is a private equity firm that currently owns 11 different businesses. Mike started his career at Procter & Gamble, where he spent 6 years before attending Harvard Business School. Mike graduated with his MBA from Harvard in the year 2000 and soon after launched Strength Capital. So Strength Capital started as a private equity fund where they launched several different funds before deciding to convert the firm into more of an independent sponsor in a deal-by-deal basis. During our conversation, we discussed what it's like to run a PE fund, where the firm stands today, how he went about transitioning from a fund to more of an independent sponsor model, how he goes about valuing a business, and where he finds the opportunities to buy these companies. We discussed a long-term vision for the firm. We also talk about some things that Mike believed led to his success, which is owning assets, the reality of failure along your way to success, remaining flexible, having fun, and maintaining your integrity. We also, at the end, discuss some great books that we read. We were both passionate about reading and great business books that are out there, so we discuss some of our favorites. So for any of you that are a business owner, entrepreneur, or looking to become a private equity investor, I highly encourage you to check out my conversation with Mike Bergeron. Hey, Mike, how's it going today?
Great. How are you?
I'm doing well. I'm doing well. So I gave a brief introduction for you, but for those that are listening in or those that are watching online, would you just mind sharing a little bit of background about yourself and kind of describe, what you do in your line of work?
Sure. Thanks for the opportunity. It's been nice getting to know you here over the last year, so this should be fun. My name's Mike Bergeron, and probably go back to just growing up. I moved around a lot as a kid. My dad worked for a big company, and so he got transferred a lot, and it really became a big part of who I was. I actually loved moving, meeting new people. But I went to high school, small town Indiana, Richmond High School, one school in town, and I absolutely loved that experience. Uh, Easy way to learn how to interact with people when you're going to the school that educates every kid in town.
Yeah.
Learn how to interact with all walks of life. But left there, went to Miami of Ohio, then started my business career at Procter & Gamble. 3 years in sales, 3 years in brand management before going to grad school. And then coming out of grad school, we started the firm, Strength Capital.
Yeah.
Wearing the t-shirt. And
Love
we've been
it.
doing that ever since 2000. For 24 years, we've been buying lower middle market businesses through leverage buyout structures, trying to grow those businesses, improve those businesses, and then sell them, hopefully, at a profit. And I'm sure we can talk about all that in more detail. But
Yeah.
the core business is buying businesses, trying to improve them, then reselling them for investors. And have been doing it for 24 years.
Yeah. Well, that's great. That's yeah, definitely grown it and a very impressive background that you have, and definitely not easy to do either. To have that type of tenure and track record is in a very competitive world of private equity is it is not an easy task. So
We
um
benefited tremendously from starting young and being relatively naive. My partner and I were 27 and 29 when we started.
wow.
Five days outside of getting our MBAs, and I'm very serious. The naivety that comes with youth can be an absolute weapon, and because we were not in any way, shape, or form prepared
Yeah.
for what we were trying to accomplish.
Right. So take me back to those early days then, because two guys, they're late 20s, and I'd assume step one is to go out and start raising money, correct?
Yeah.
Right? I mean,
Yes.
sure you weren't self-funding, these acquisitions. So So how did that go? I mean, how did that work? Trying to approach investors, trying to raise capital. How was that process?
Yeah, it's a very standard story. We had an old guy who was willing to introduce us to his friends, and the old guy was my partner's father,
Okay.
and he thankfully is still alive. He's 89 years old. He's definitely one of the smartest people that I've ever met. Um, Definitely one of the best people I've ever met. And he was a super well-known, respected Detroiter, retired Ford Motor Company executive.
Okay.
He went to the same grad school as my partner and I, and he performed far better academically there than we did. The guy was just awesome. He
Yeah.
introduced us to his friends, and I don't believe we got an ounce of capital that was anything other than what I would define as mentoring capital. I think that these were all older people who were young once, chasing after something, and they were looking to provide us an opportunity. I don't think any of these I don't think anybody gave us money with the expectation they would get any return.
Yeah, right. Right. Yeah, not expecting to get rich off of that investment.
Yes, exactly.
Yes.
Exactly.
Yeah. Yeah. Okay. Well, great. So you're so for that first fund, was there a target? Were you looking to raise a certain amount of capital? Um, that would kind of be step one, part one
Yeah.
of the question. And then two, did you already have some businesses identified that
Yeah.
you were looking to make investments in?
No. So the target was 100 million, which is ridiculous. There was just no way that was going to happen. The story that I appreciate about it is my partner and his father do think differently about the world in a very positive way. So their line was, "Hey, we'll just come to Detroit and buy a house, and then we'll get going." And I was like, "Well, how much money do you guys think you have raised?" Because they had been out for a few months,
Hmm.
shaking the trees before we graduated. And they were like, "Well, we think we have like 1.5 million raised." Okay, we're going to get 2% on 1.5 million. That's $30,000, and we have two mouths to feed.
Yeah.
I
Okay.
don't think I'm going to buy a house. So I actually ended up, my wife and I moved into the garage above the old man's house, the father who's helping us
Okay.
raise money. Now
Yeah.
he still lives in probably the nicest house I've ever been in,
Hmm.
and thus the garage apartment was
Yeah.
not bad, but it was
Yes.
still a garage apartment.
Right. Right.
Uh, and we ended up raising 27.9 million, which was sufficient to give us a start.
Hmm.
Ended up running the business out of his house for 2 months before getting an office, and just progressing from there. We did not have any businesses identified. We just had to
Okay.
start marketing ourselves as buyers of businesses, and it took us it took us till it probably took us 12 months to close the fund. We bought our first business maybe 9 months into the company's history. So uh, within probably 12 months, we had our first two, which in
Yeah.
retrospect was pretty quick. Actually, I think it felt slow to us at the time, but that probably was fairly quick.
Yeah. Yeah. That is. Well, that's a lot of blind faith, from those investors, and that's great. So what did those early days look like? In the office, you and your partner, and moving to Michigan, but then as the money started to come in, how was most of your time spent at that point?
It's just the first thing I would say is it was like they were thrilling days and thrilling times because we
Hmm.
were pursuing something we wanted to pursue. We were not uh, working for anybody per se. Clearly, we're working for our investors, but we didn't have
Right.
a day-to-day boss. My partner would say to this day he was not capable of working for somebody.
Hmm.
I was capable, but it was not going to allow me to live my best life if I
Yeah.
was working for somebody.
Yeah.
And then our time was spent marketing, trying to get into deal flow. Be guys that brokers of deals or business owners were willing to talk to about their businesses. That was the majority of the time. Once we started to get into the deal flow, it was all about, it was probably all about my excess risk aversion and my partner's willingness and desire to just get a deal done. And we were both right. I mean, we needed to get stuff done. So he was
Right.
100% right. And my risk aversion to not get our head taken off early, because with any business, you can kill them quick if you're not careful.
Right. Right. Yeah. Yeah, I believe it. So, well, great. So that was fund one. And what were some of the, um, some of the intricacies? Obviously, there's raising the capital, there's finding the businesses, there's closing those deals. And then what about the other side, the reporting and what else goes into that, into running the fund, on
Yeah.
a day-to-day basis?
So I think the real high level things that came out of the first fund, the first was neither Mark or myself are accountants. And we started out outsourcing our financial due diligence to outside firms,
Hmm.
accounting firms. Big mistake. Not to say they're not good at their jobs, but
Right.
they don't care like the people who are putting money into it care. So
Right.
we learned a couple of hard lessons up front where we ended up not fully understanding the numbers. So as we started to add people to our organization, it everybody in our organization comes from an accounting background or a transaction services background at a big accounting firm. And why?
Mm.
We need to know, we need to have a decent level of confidence that we know the numbers, right? There's a tremendous information asymmetry. The seller's always going to know more than us. So if we have some hardcore accountants, we give ourselves a chance of understanding what's going on.
Right. Right.
So that's probably the biggest lesson. The second lesson would be, and I'm not sure this was necessarily a surprise to me, but you have to be willing to make changes. Like
Hmm.
we put ourselves in a number of difficult positions where maybe management wasn't great. Well, if it's not great and you try to work with them and it's still not great, you can't remain static. So you have to be willing to make management changes.
Right.
Um, and it's not only is
That
that
had to be
maybe
difficult. That had
it,
to be difficult.
it's and I would describe it this way. I don't usually by the time we made the change, it wasn't that we were nervous about the actual change. It's more what comes after, because then an organization either doesn't have a leader for a period of time or has a new leader. And
Hmm.
candidly, our track record on hiring replacements was very poor. Probably still is. It's to make a decision to remove somebody is one thing. To assume that you have an improvement or an upgrade, that's a risky thing.
Yeah.
You know.
Yeah.
So that would be the third thing I would say that you learn, and this has got to be the same way with your business. If you look at what's the driver in a typical private equity fund, let's say you're going to have 10 investments. Those investments are going to perform along a bell curve. You're going to have winners, you're going to have middle of the road, and you're going to have some real garbage.
Hmm. Hmm.
If you're smart and you're willing to work, you will typically be lucky enough that you'll have one or two, maybe three, that outperform in a way that makes up for a lot of your dumb decision making across other parts of the portfolio.
Yeah. Yeah. Yeah, that makes sense. I've heard that is true in private equity, and then obviously for venture investing as well.
Yeah.
That seems to be the case. So
There's on that point, it's I have a little bit of passion for this. Like the large institutional investors will sometimes really lean in to a private equity firm and say, Well, no, venture, you're supposed to have some losers. This
Yeah.
is private equity. These are leveraged buyouts. You're not supposed to, it's supposed to be a really consistent uh, return profile across your investments. Anybody that's ever been in private equity and looked at the numbers knows that's not true.
Yeah.
And it's one of the guys that has some incredible, theories and writings out there about that, Steve Schwartzman from Blackstone.
Right.
He'll talk your ear off about the ones you think are going to be winners are losers.
Hmm.
Everybody's always going to have losers, but it's the winners that matter.
Right. Right. Yeah. Yeah. So when you mentioned in the early days you would outsource the valuation, then you started to bring that in-house. What were some of the methods that you use and continue to use for valuing companies and really trying to land on that purchase price?
Yeah. So it really, it begins with trying to determine what you think the core EBITDA of the business is.
Hmm.
The core operating profit is a more generic way to say it. And, our accountants go in there and they descend on the business and try to figure that out.
Yep.
From there, um, obviously we're going to model businesses. My co-founder is rightfully proud in that he built our integrated leverage buyout model from scratch. He's a former Goldman guy and he liked doing that stuff. We still use the same model where you're modeling out every aspect of the business.
Hmm.
Essentially what you're modeling out is the cash going in, how the cash behaves over the course of your whole period, and what type of cash you take out when you sell the business. But
Right.
so you're looking at, what type of working capital is required to run this business. Could you change how much working capital you need to run? What type of capital investment is needed? And all of what type of growth rate would you forecast?
Right.
All of those things get modeled, and it's a decent way to give you a sense on what you could pay for a business.
Hmm.
Beyond that, typically you're in a competitive process, so somebody's trying to get you to pay more. There's people that might be willing to pay more. So that's when you get into maybe more of the soft skill negotiating parts of the process, which are important. And I will probably talk about that at some point
Yeah.
in this
Yeah.
conversation.
Okay. Yeah. So that makes sense. And if there's different formulas, different sets of ways, um, in finding that true EBITDA number, maybe that's a quality of earnings report, those types of things to really start to bring out that cash flow in the business.
Yes.
Um, so during the point, I know there was a point in the firm where you went from having a fund to transitioning more to kind of an independent sponsor type arrangement, finding a
Yep.
deal, then finding the investors and going out and doing that. So what brought about that change for your firm?
Yeah. The main, well, there's a few things, but I the I'd start with saying that both business models are really good. Both business models are viable, whether you're raising a fund, a pool of capital, where you as a general partner really have full mandate on what you do with that capital, versus finding a deal and funding just that deal. The, the issue that we had with the fund model is you're raising 10-year vehicles that by all objectivity are 15-year vehicles, because you never have everything sold within 10 years.
Yeah.
Oftentimes the things that aren't sold at the end of the 10 years are the garbage businesses. So you're nursing those things along.
Right.
And when you're 27 and 29 and start a business and you're raising 15-year vehicles, that's different than being 40 and raising a 15-year vehicle. Like I can
Right.
do that math and say, you're going to sign up for 15 years of this. There's also, I would say that, and this is not a positive or a negative, it just is, we're very entrepreneurial. A
Hmm.
fund can have a narrow mandate,
Yep.
and if there's something very opportunistic that comes your way and it's not within that mandate. You can't touch it. We absolutely got worn out on annual meetings. They're, call it big song and dance type of activities that
Yes.
weren't all that value added. And candidly, if we looked at our history of annual meetings, I don't think our predictive powers at the annual meetings were that good.
Yeah.
What
Right.
what we told
Yes.
investors, I don't think, it was that predictive, and that's not great. We don't want to be in that position.
Right.
Practically speaking, between our second and third fund, we were out of money and we did 2 deals. And at the time, those 2 deals became the best deals the firm had ever done. That was just dumb luck at the time.
Yeah.
But it showed us an opportunity to pursue a different business model, which was more entrepreneurial and had a number of other benefits associated with it that we thought we knew at the time, and have probably proven themselves out over time as well.
Right. Right. Yeah. Well, great. So you made the switch, and so in order to do that, right, you've got to have some recurring income, for
Right.
yourself, for the firm. So is that where you mentioned, were there a few businesses that were there that you thought, hey, we can hold these for the long term. They'll provide us with, distributions or the income that we need to live on, right? And then also to keep the firm going. So I'm assuming some opportunities like that came about for you.
Yeah. So the way it worked practically at the time, we still had a second and third fund that were live. There were economics coming out of those funds to us. That was essentially the bridge that you're talking about,
Yeah.
John.
Yeah.
And then we had to do the math that we could create enough new investment platforms as those funds ran off that we would have a fee base to be able to, keep our team employed.
Right. Right.
That
Okay.
and that if you talk to anybody, the biggest benefit of having a fund, it's not necessarily a great benefit for the LP, but the biggest benefit of having a fund is that general partner has a guaranteed fee stream for a period of time. And
Right.
it's a very, you talk about a business that's easy to budget. Well, you know what the size of your fund is, you know what your management fee
Uh,
is,
yep.
multiply that, and then you have
Yep.
5 years of that exact number.
Right. Right. Yeah. Yeah, absolutely. It can be definitely lucrative, but like you said, not very budget intensive, and
No.
you can get those numbers right, which is great. So one of the questions too, like, what have you found to be some of the best strategies for deal flow, for finding opportunities?
Yeah. Um, it's I'll slightly change it's like finding and landing opportunities. So I slightly changed the finding opportunities is candidly, uh, we've been at it 24 years. We're in the market. We're pretty well known.
Hmm.
We also, we're in the lower middle market where people sort of know what we're looking for. Um, and even at all of that, I don't think we're even that good at it. Like we all sit around and think about how we could be better at deal flow. Maybe the best thing for us now is we have a group of people in Detroit that's well known. We have a group of people in Cincinnati that's well known, and we have a group of people in Denver that's well known. And those 3 geographies, because of our presence, tend to bring opportunities our way.
Right.
And then the landing is, it's I would say it's the more important part of the equation. Our deals um, invariably get landed because the seller, whether the seller is the founder and they're the true decision maker as to who this business is going to get sold to, or whether the seller's more of a professional manager and he's working for private equity already or some other investors.
Hmm.
The entire objective is completely authentic, be who you are with sellers. And through that process, have them conclude that they could sell their business to a few people, but they would really like to work with you,
Right.
in our case, Strength Capital. And
Hmm.
most of the times when we've ended up securing a transaction, we hear very quickly after our initial interaction that the seller would like to do a deal with you guys.
Yeah.
And then the whole attitude is, let will you work with us to try to deliver that outcome for the seller?
Yes. Right. Make them like you. I
Make
mean,
them
that's,
like you.
yeah.
And I don't know if it's private equity. They're like any industry would have a variety of different reputations. If there's one that might be fairly well earned, it's this industry can be pretty uptight. So our argument has always been it's not that difficult to go into a meeting and differentiate yourself. And one of the things would be not talk too much about yourself. That would be
Right.
step one.
Yep.
Two, be truly interested in learning about a new business, which, and I'm sure you feel this way, that's like one of the most enjoyable things you could do anyway, go learn a new
Yes.
business. So
Right.
we don't have to fake that. Like
Yeah.
we're damn curious.
Hmm. Yeah, that's good. That's good. And there was a couple things I know that you wanted to hit on today, and these are things that I'm highly interested in as well. But it just from also from hearing you speak before. So I mean, I've heard you speak at conferences and things like that. So taking risks. You mentioned that. You mentioned that was where you probably had to push your partner, maybe a little bit. And, that can be a difficult thing if you've got family and things like that. So, along your career, what type of risks, did you take, and how important was that to you throughout your career?
Yeah, not to correct you, John, but I would say my partner taught me about taking risk more than
Okay.
I taught him.
Yeah.
I was I was we always laugh. He was overly optimistic. I was overly pessimistic. We sit here 24 years later. We're pretty well synced up in the middle. Like
Yeah.
he taught
Yeah.
me some stuff. I taught
Right.
him some stuff. But you know, a willingness to take risk might be the most differentiating thing for anybody in their life. And I mean, it just starts with a basic premise. You know, in any industry you're going to be in, you're going to be competing against people that most likely there's enough of them hardworking that it feels like there's competition. Most likely there's enough of them that are well educated that you're going to feel like there's competition. But where you can really start to differentiate is being willing to take risk. A lot of people are very risk averse. And,
Mhm.
our stance would be within Strength Capital, and we've really spent a lot of time working with our younger people about it, is too often people think bad things come when you take risk.
Yeah.
And the reality is a lot of time good things come when you take risk.
Hmm.
And if you are going to put yourself in a position that you either decide you won't quit after failing after taking a risk, or you're going to put yourself in a position where you put multiple risks on the table at the same time,
Yeah.
in almost every situation, your winners will outrun your losers.
Right. Right.
And then how do you get paid? You get paid by actually having financial risk in those situations.
Hmm. Yeah. 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 Absolutely. I love that take on risk. And, one of the other things that I've heard you mention in the past is, kind of failing, how much failure plays a role, in your path to success.
Yeah.
Maybe some obstacles that you faced, or even learning from other people's failures as well.
Yeah.
Does that played a pretty strong part in your career?
Yeah. So, one of the things you and I have connected on, we were actually talking about before this thing kicked off, is just
Yeah.
reading business history. And,
Mhm.
probably makes us nerds, but we both love it.
Right.
And, you cannot identify anybody that's well known in business history, probably much more broadly than business history, that wasn't a spectacular failure at some point in their business career.
Right.
And um, so I always say the only path to success is through failure, and it's a fact. And there's the obvious ones. How is it that the guy that created the most valuable company in the world was fired by that company? Steve
Right.
Jobs. He
Hmm.
obviously had a fairly healthy experience with failure and a fairly productive attitude about failure.
Yep.
Um, so it's just demystifying. I think it's really important for young people that you demystify failure to them. I mean,
Right.
when I worked at Procter and Gamble, the career trajectory really was from the lower left corner to the upper right, just kind of this trend line.
Hmm.
And if you got off that trend line, well, then you were screwed, kind of. You weren't going to get to the top. But failure is much more, you're heading up and to the right, but man, there's some wobbles along the way.
Right.
And, just got to get comfortable with it, got to deal with it. We used to get really uptight about when investors would, hey, we're with you fund one, we don't want to be with you fund two, or we did this particular deal with you, it didn't go super great, so we're not going to do the next. And one day we started talking, we're like, has the Berkshire Hathaway shareholder base been the same since day one? No. What
No.
that means is Warren Buffett has been fired countless times. Does
Right.
Blackstone have the same institutional investors that they did day one?
No. No, you read
Schwartzman's
that all
talked
the time.
about it.
Right.
He's
Right.
been fired countless times.
Yes.
Those are failures.
Hmm.
Did
Right.
it stop him? Did not stop him.
Yeah.
So now we don't like it if somebody leaves, and we try to learn a lesson. We are
Yes.
like we carry ourselves with humility. What can we learn? But it can't it
Hmm.
can't it can't overtake your direction or your plan.
Right.
Yeah.
Right. Yeah. Yeah, I agree. And one of the things that you mentioned to me just in the past, and it seems like kind of a few of your core principles: remaining flexible, having fun, maintaining integrity, are all things that you've seen to kind of woven into your life and your firm. So what are some of your thoughts on those topics as well?
It's all true. I think all true. I mean, we're
Yeah.
really committed to the fun and not taking ourselves too seriously.
Right.
Now, when it's time to roll, it's time to roll, and we don't have any problem with that. But I think that that's almost like the default for most business people. And if you can, be yourself and have some fun along the way, it's a much better
Hmm.
existence. Um, the flexibility, if you were to go on our website and read my profile, I think it really stems from, like, we try to have a very strong listening orientation.
Hmm.
And if you go into any interaction with a strong listening orientation, you're much more likely to hear opportunities or see opportunities or sense opportunities. There'll be times where we're going into a meeting and one of our young guys they'll talk about their preparation for the meeting, and is it correct, and are we prepared for everything? I'm like, you're forgetting like the greatest business hack of all time. It's okay if you're not prepared.
Hmm.
Go in there, show more interest in them,
Yep.
ask a bunch of questions. We'll learn so much. You can go back to the office and get real prepared based on
Yeah.
what we
Right.
learn. And
Right.
there will be a few examples over time. I'll give you a quick one. The first investment we ever did since we started talking about the founding of our firm was a propane business in the
Mhm.
city of Detroit.
Yep.
We owned it for 11 years. We got one times our money back. So this is a zero IRR.
Oof.
Better than a zero,
Yes. Right.
meaning a $0 back.
Correct.
We got And we had another private equity firm that was a partner of ours in that deal, and they got to the end of a fund life, called us and said, we got to sell the business. And if they wanted to sell the business, we had to ride along.
Yep. Yep.
So they led the process. They got 2 offers for the business. They were pathetic. And so, again, being flexible,
Mm-hmm.
I went into my partner's office and I'm like, well, here's the offer. And he's like, oh God, can you believe we have to take that offer? I said, we're not taking that offer. We're going to do it. Well, what do you think? I'm like, we'll just go to all of our shareholders and say, this is the process that was run, fully marketed process by our investment partner. They want to sell, we don't. So
Mm-hmm.
we're going to buy instead of sell. And if you guys want your money, we actually don't blame you. We've been terrible at this investment for 11 years. You can have your money. Or if you want to ride along with us, ride along. Every investor sold. It was a completely rational decision by all the investors.
Right.
Because they were tired and we had not proven any capability in that business.
Mm-hmm.
So we ended up buying the business. It was highly levered because we had a bunch of lenders who liked us and liked the transaction. And then completely randomly, it would have been an average investment for us, but completely randomly, the polar vortex hit the Midwest. It was a propane distribution business. The thing went to the moon.
Wow.
Big public company came to us 2 years later. And it ended up just being an incredible outcome. And it's just because we knew how to flow with the situation, basically.
Mm-hmm. Right. Right. Yeah, that's an awesome story. And it speaks to, one of the things that Warren Buffett talks about a lot, just staying in the game, right? Just staying around. And being in the business and day after day, just surviving, so that you can have the opportunity to have those very successful events.
You think we're really, really uptight about understanding what we own. There'd be times where I would think we might even be too uptight. Like our young guys get really worn out understanding what we own. And it's not easy. These businesses, even though they're small businesses, they're complex. And when
Right.
things go wrong, to try to figure out what to analyze what's going wrong is tough. And the one thing that we'll say with, I would say, confidence, everything else we just let people know we're doing our best. But I would say the one thing with confidence we'll tell people, when things go wrong, and they will invariably go wrong on every investment, we roll out. Like, we get very intense because it's exactly what you just said. If you can stay alive,
Yep.
good things will likely happen. Now, we haven't succeeded 100% in that, but we've been through some very challenging situations where we've stayed alive.
Mm-hmm.
And then the outcome on the back end 4 years later is, some of them have been such that, our investors couldn't believe it.
Right.
Because it was that bleak, right? Before we saw the sunshine.
Right. Yeah. Yeah, absolutely. And then one of your, obviously this had to come up for you time and time again, while running the business, while raising a family, things like that, but sacrifices, right? So things you had to give up along the path that were necessary towards success. How did you handle those things? Maybe it turned some people away. What did that look like for you? And what did you learn from that?
So I always hesitate on this one a little bit because let's start with the most important thing. Like, we all have our own personal lives and our situations.
Mm-hmm.
My wife and I had a very clear, comfortable understanding, meaning she got to do what she wanted to do. I got to do what I wanted to do. And she made things very easy for me on the personal side.
Mm-hmm.
Now, but that comes around to, I am a huge believer, and especially with younger people, I don't understand the sacrifice thing. I think we all have enough talent to kind of do it all. Like I have been way into my business. I've tried to coach every team when they were younger. I was highly involved in the kids' school and the board. I absolutely love working out. I definitely had friends outside of work. Um, I like to read a lot. Sometimes
Hmm.
I was told I was reading too much, and I actually agree with that. But
Yeah.
it's we all have our talents, and if you're willing to work hard, the day's pretty long. And I know you got 5 kids, and I know it's a juggle, but I
Yes.
also know you juggle a lot, and you're
Right.
able to get a
Right.
lot done.
Yeah. Yep. I agree. Yeah. It seems like there's, you can shed some things, you can drop, there's always, the 80/20 rule, right? What's some of the 80% stuff that you could maybe delegate,
Yeah.
give to somebody else to be
I'll
more.
tell, I'll give you a Cincinnati one that I actually learned about recently,
Yeah.
and I think that this would apply to our firm a bit. I bet if I want, well, we talk about this. If we wanted to lock in harder than we locked in, our firm would probably be bigger.
Hmm.
And I mean, the guy clearly has a reputation in town, but I read Jeff Ruby's book last year.
Yeah.
Great book. What a story. And one of the things he said, and the trajectory of that business makes me believe it. When his kids were younger, he wasn't looking to grow. He was looking to just kind of manage what he had so he had time to give to his kids. And
Hmm.
then when they got a little older, especially when they decided they wanted to get involved, that's when the real growth started.
Yeah.
So now my youngest is going to college in 6 months. So I do wonder, like maybe that's something that's going to happen with me. I don't know. What I know is there's a lot of hours in the day, and people should not put limiting thoughts in their mind, like, well, I can't work out anymore because I have 3 kids. What do you mean you can't work out anymore? You have
Right.
3 kids. That
Yeah.
doesn't make any sense to me.
No, it's more reason to work out.
More reason. Yeah. You
Yeah.
need energy for them, and you got to be a
Yes.
responsible person and be around for a while for them.
Right. Right. Agreed. Agreed. And one of the things that want to make sure we touch on today too is owning assets.
Yep.
That's an important one, and that can obviously give you a lot of freedom, right? Flexibility around the decisions that you make, how you spend your time. What are some of your thoughts on that?
I think the only true path to benefiting and taking advantage of the freedoms we all have as being citizens of the USA is to own assets. I think the if you own assets, you you create all kinds of potential for yourself to get lucky.
Yeah.
If I'm ever talking to like younger business students, I always say own a bunch of assets, put yourself in the path of success, and I can almost guarantee you'll get run over in a couple situations. Like run over with like smashing success. And
Windfall. Yeah.
yeah, and when it happens, let me say this, I've never talked to a good businessman that had an ounce of humility that didn't chalk up a lot of their success to luck.
Hmm.
I mean,
Right.
but you dramatically in, enhance your chances of getting lucky if you own stuff.
Yeah. Yeah.
We owned a pallet business in Chicago a couple of years ago. Uh, Really nice business. Incredible founders, brothers founded the business. Two of the smartest guys we've worked with in 24 years.
Hmm.
Sucker was a winner. And then COVID came
Right.
and it became a ridiculous winner.
Yeah.
Now they had the foundation because they were brilliant brothers, brilliant business leaders, but
Hmm.
a lot of the things that drove excess results there, we did not do anything. It was just COVID came and shipping went crazy and
Yep.
inflation went crazy and the business had to be managed in a certain way
Hmm.
and the business became more valuable. That
Right.
so we all, I mean, and our investors loved us for that outcome. And we said, well, okay, we picked two great guys to work with. I think
Right.
we picked a decent industry that had nice dynamics. We definitely picked a great geography. Everything else, we got lucky. We got lucky.
Right.
We got lucky.
Yeah. Yeah.
So you got to own. You can get lucky in many ways in your life, but if you really, really want to get lucky, you got to own.
Right.
And I always say that, it doesn't mean you have to have your own business. You can go work at a company and go find a great company, progress yourself to where you start getting stock options. You can get really lucky that way too.
Yes. Yeah, absolutely. Yeah. Or there's, yeah, money you can make, turn your earned income into passive income, whether it be real estate,
Totally.
whatever other type of asset it might be. So,
Totally.
um, yeah. And so for you, before we wrap up, just a couple of last questions here. I was curious where the firm sits today,
Hmm.
and then what's kind of the long-term vision for Strength Capital?
Yeah, great question. Well, first of all, I'd say we just love what we do.
Hmm.
And we have a really great team of people that we work with every day. And we're all partners. We're not hierarchical here. We're all in this together. We all have unique talents.
Yeah.
And um, a positive thing for Strength Capital is our track record has improved over the last 24 years. Now, if you think about that logically, you would hope so because we knew nothing when we started. And today we have 24 years of experience.
Yes.
But
Right.
but our track record is better. And I think what we have a real good sense for now is the type of business that we like.
Hmm.
We like certain manufacturing businesses. We like industrial distribution businesses. We like industrial service businesses. And we definitely know the type of people that we want to partner with. And it's good people, easy people. When things go wrong, you're going to be able to resolve issues with them. And then we get returns a lot of ways, but if we can find something, and this is a standard private equity model, but if we find something that we can grow through acquisition, that really excites us. So as
Yeah.
we think about going forward, we want to be an environment where our young people have a great opportunity to stay here, grow here, continue to do, really interesting deals.
Hmm.
And we sit here today with 11 portfolio companies. If we could get that to where we always had 15, there'd be more work to go around here. And,
Right.
probably enough like economic potential to keep everybody happy and keep a firm that was, growing and very robust.
Hmm.
Uh,
Yeah. Well, good. All right. Last topic we got to touch on is reading. Right. So
yes.
reading in books, you've stated the importance of it. If you can learn from other people and learn business history. So what are some of the either the best books you've read or that might also be, business owner or just people in business that you follow, that you get a lot of insight from, things like that. So topic's completely open. It could either be names of books, book
Yeah.
recommendations, or people you follow and read about and make sure that you're consuming anything that they're putting out.
Yeah. It's not so much the latter. It's more historical figures.
Okay.
Um, so I am big business history guy. I think I learned it in grad school in that the most preference classes in grad school were business history classes. And it like confused me until I got exposed to it.
Hmm.
And it just starts with the foundation that there is nothing going on today that hasn't already been done, or there's no issues going on today that haven't already been experienced.
Right.
And you can just kind of look back and say, well, there's probably some people that figured it all out. Well, those were the most successful. So, and these stories are sagas. Like I I think my go-to now for somebody who's like looking to dive into the genre is Shoe Dog by Phil Knight. Is
Mhm.
completely readable. It's a brand that everybody knows and connects
Right.
with. Um, on most reviewers lists, it actually already scores very well, like
Yeah.
all-time business autobiographies.
Hmm.
So I love that one. I love reading about Andrew Carnegie. His autobiography is
Yeah.
it's just so fundamental. And then the idea that he sold his company to JP Morgan, that's pretty cool bit of the history. We were
Right.
talking Rockefeller, Titan
Hmm.
by Rockefeller, which I know is on your shelf.
Yeah.
It's big, but it is it's incredibly instructive.
Yes.
So I, they're page turners for me, which again, that's like nerdy, but they are page turners, and the lessons really are timeless. Another one that's more theory, but Peter Thiel's Zero to One,
2 to 1.
very
Yes. Yeah.
readable.
Got
I
that up
mean,
there
I
too.
I can't imagine a young person putting that down and not thinking they got a ton out of it. I'll give you two more. I get my brain going. Ken Langone, I Love
Okay.
Capitalism, unbelievable. And then
Get that
Sam
one.
Zell, Sam Zell just died.
Yep.
Am I being too subtle? Like I gave that to my college age son,
Hmm.
and like college age son gets business book. What's this all about? I knew he would love Shoe Dog, which he did, but Am
Yeah.
I Being Too Subtle is very readable, and
Yes.
there's not one thing in there that's just not like so core to like how
Right.
you do business.
Hmm. Yes. Yeah. Those are all great ones. Yeah.
What about you?
Yeah, I've, it's definitely varied, as far as, if I get questions and to me, when it comes to reading, I really think the quote that says, when the student is ready, the teacher will appear.
Yeah,
I mean, that hits home to me so much because I would read a book 5 years ago, and then I would go back and I would think about that book again. And it's like, okay, now this makes even more sense with where I'm at in my career than it did to me 5 years ago. And then there's books too that have somewhat of the opposite effect. Like, okay, I used to think that that was a good one, and now it's, less relevant.
yeah.
Um, so I think that you can really learn a ton. Same thing. I love the history books. I think there's, if anyone's getting started, I would call like my foundation of books, money related, would be Rich Dad, Poor Dad, Millionaire
I,
Next Door, Think and Grow Rich,
oh,
would be
all
on
good.
there. And then How to Win Friends and Influence People would kind of be that's like your foundation. In my mind. And then I think it can build from there. Some of the more recent ones, Psychology of Money by Morgan Housel. I thought was a great
Excellent.
book on money. Um, What It Takes, Steve Schwarzman. I mean, that one,
Unbelievable.
yes, that one's a great book. I've dug a lot into the Warren Buffett way, and just listening to the essays of Warren Buffett. I found a lot of Buffett and Munger stuff through podcasts and YouTube interviews on them. Sam Walton is a really good one, Made in America.
Okay, so that would be that would be 1A, 1B with Shoe Dog. You can read,
Yep.
anybody can read Made in America and understand it completely.
Yes, yes, yeah, I agree. And his, you mentioned the asking questions. The stories of him going into other stores, right? I mean, he would go into other department stores. He'd ask for the owner, and he would literally have a briefcase and a notepad, and he'd sit there for hours and just ask him
Yeah.
every single question he could. And he'd come off like, "Hey, I'm just this guy from Arkansas. What do I know?" And it's amazing. He said it himself. Everything he's got, he's learned or stolen from other people in their mind, and then he used that in his business. So for him to say that, who, arguably, if he wouldn't have split his wealth in the different ways, would be the richest person in the world,
He That's right.
then it's like, why would you not want to read then? Why would you not want to learn about your industry, other people in your industry, and then the successful people in other industries and how that might relate to you? So
I tell you, we'll go full circle here before we end.
Yeah.
Sam Walton, big failure. He had, I
Yep.
think it was 15 plus or minus two stores, and he ran into trouble with the landlord.
Yep.
Concept wasn't exactly perfect.
Hmm.
I mean, he was deep in his career, at least 15 years
Yeah.
failure before he started Walmart.
Yep. He
I
was.
mean, he was father of kids like your kids' ages.
Yeah.
He was member of community failure, and
Right.
then he started Walmart.
Yeah. It's amazing. It's amazing. And him giving ownership shares to his kids early on. I mean, he talked about it even, it was even late in his career needing to go public because they had so much debt on the business. I
Yeah,
mean, it was
he
big
was
risk
growing like
taker,
crazy,
right?
growing like crazy. He had to finance. Think about it. He had to finance real estate
Yep.
and inventory coming out his ears. I mean,
Right.
that thing. Same thing with Phil Knight. You just consume capital. Your growth consumes your capital.
Right. Right.
It's tough.
Yeah. So those are definitely great reads. One of the more recent ones, 10x is easier than 2x. I read that
Yep.
last year. It's a pretty
It,
good
it
one.
it's a good one.
Atomic
I agree.
Habits is pretty good as well. James Clear is just
Yeah.
kind of like a more like a life strategy. But Atomic Habits I thought was pretty good. Traction. I don't know if you've read Traction.
Have not.
Yeah. Yeah. That one's it reads like a textbook, honestly, not a page
Yeah.
turner, I
Yeah.
would
Yeah. 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 Yeah.
say.
Yeah. Yeah.
But no, definitely interesting. So, but yeah, I could go on for days. Same with you. I read, and then and in the back of my mind, there's always, okay, is this time spent elsewhere? Should it be? Is there anything more productive I could maybe be doing? And it kind of you have some of those thoughts that come in your head when you're reading. Um, but I look at it as a long-term investment.
Amen. Amen.
Yeah. So
Well, I'll say one more thing on this as an encouraging thing. I forget where I learned this from, but it's true. The great news is, and I do this all the time, if you're not like drawn into the book within 10 pages, it's okay to not chew through it.
right.
This is not high school. This is not college where those teachers force you to read it. You
Yes.
don't, maybe you wasted $8. Who cares?
Right.
Put yourself into stuff that you are like late for dinner because you're that excited about reading. You don't need
Hmm.
to chew through anything. We're adults. You don't need to
Right.
chew through anything.
Right. Agreed.
Yeah.
Yes. Yeah, I agree. I agree. A good historian on I would say historian on the investing world is Howard Marks. Howard
Oh,
Marks,
he's outstanding.
Mastering the Market Cycle
Outstanding.
has been tremendous for me as well from an investment world. And just like you mentioned, this stuff has all happened in the past. A lot of this stuff repeats itself, and the stock market can be the same way. Might not
Yeah.
be identical events, but similarities are there for what's gone on in history. And he writes memos. He's written 2 books. His stuff is really good.
Outstanding. Just
Yeah.
start by go to his website and read his memos.
Yes.
They're
Yeah.
free.
Right. Right. I agree. So, Mike, I know we could go on for much longer, but it's getting long in our time here, and I can't thank you enough for the time that you've spent, for the wisdom you've shared throughout this past hour that we've been talking. If there's anyone that's interested in finding you, connecting with you, learning about Strength Capital, or maybe looking at it in a potential investment from Strength Capital, what would be maybe the best way that they could find you or get in touch with you?
Just go to our website and either call me or send me an email.
All right,
Just
simple enough.
strengthcapital.com.
Well,
Yeah,
great.
it's been fun, John. Thanks for the opportunity, and good luck to you. And obviously, really look forward to building our relationship.
Yes, absolutely. Well, good. All right. Well, it's good to talk to you, Mike.
Great. Thank you.